The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to the GoPlan 101 Financial Wellness Webinar. Today we're going to be talking about risks in retirement, life and long-term care insurance. My name is Jim D. I'm with Greenleaf Financial, and here with me is Jim Hiles, Managing Partner with First Capital Advisors.
Good afternoon, everybody, and we're going to be looking at some of the impacts of the risk of life and long-term care and what it means to your financial wellness. So stay tuned for a really exciting 20-minute seminar.
And away we go.
Okay.
So our motivation, financial wellness is really our motivation behind these webinars. And what we really believe is that true financial wellness goes beyond just your investments, which is what we see a lot in the marketplace. We think that it involves all of these topics that you see up here today. And today we're going to be focusing primarily on just a few of them. It's going to kind of dovetail into insurance, Medicare and healthcare, and also long-term care. So when we talk about the three phases of personal financial planning, we're referring to these phases: the accumulation phase, where people are primarily focused on growing their assets, growing their money over time. Then we enter into the distribution phase, which is a major transition when we're trying to figure out how we're going to distribute income from the assets that we've accumulated over that period of time. Then we enter the transfer and preservation phase, where we're thinking about things like our legacy and what we're going to leave behind for our family. So today, again, we're going to be focusing primarily on the income and the legacy components. And Jim Hiles, we're going to talk about some of the major risks to retirement lifestyle as we see them in our business. So you want to discuss some of these?
Sure, I'd love to talk about risks.
Thanks for doing that.
Happy holidays, everybody. It is December after all. So yeah, we're going to be talking about everything that we're talking about with money generally revolves around getting to a better place in life. And the things you have to deal with are things like risks. We've talked about a number of these already in past webinars. We'll continue to talk about them, but budget, market, inflation, and longevity, which is an interesting risk. And that basically means that you're going to be living a long time, which, you think about it one way, that's good news.
Right.
But on the other hand, somebody's got to pay for you. And that means it's going to be you paying for your long life expectancy.
Hopefully.
And we're also going to talk about healthcare costs and premature death. Obviously, that can make for a bad day, too. So let's go ahead and get into the risks a little bit more. The first one's kind of an easy one, and that is what happens if you were to die early. And that means before you've had the opportunity to either accumulate enough for retirement, or if you're even approaching and going into retirement, should you have life insurance on your life? We get this question a lot, particularly as it relates to group insurance or term insurance. And we do think there is a reason for term insurance, or life insurance anyway, after retirement. And it could come in a number of different forms. For example, more people are going into retirement with mortgages than ever before. And this creates additional risk. In other words, if someone dies prematurely, there could be a loss or a decrease in income because of Social Security changes of income, because maybe a pension change of income, just getting over the loss of somebody on top of that. So you have debts that you might have to incur or pay off, or might want to pay off, and mortgage would be a good example of that. In some situations, maybe you just didn't fund enough for each other while you were alive, and you want to create an estate, and insurance can do that. And life insurance, even at age 65 and 70, is affordable. It is for term insurance. We didn't used to think this. Now it is an affordable risk management tool to buy term insurance out there at 65 and 70. The other things you'll do with insurance is, hey, if I stop working and because I got hit by the beer truck, who's going to take care of the spouse and family because my income is gone?
Right.
And that's a traditional income replacement insurance. You absolutely should look at generally term insurance to take care of that as well. And lastly is just final expenses to make sure everything is good when you're gone. So that's relatively easy, but it does cover, if you're looking at risk management for dying prematurely on either side of spouses or partners, life insurance works in and through retirement. So take a look at that in terms of what you're thinking about for your own insurances at that time.
Right. It's the old rule of thumb, like you were saying, the old rule of thumb was that you didn't buy term insurance in your 60s, but that's different today.
Now
right?
It's very affordable.
And longevity has a lot to do with that, right? So, here we have the probabilities of an individual male and an individual female living to various ages, right? So basically what this is telling us is there is a 75% chance that a 65-year-old male will live to age 79 and a 25% chance that that male will live to 93. Females live a little bit longer, typically. They're healthier. And when it comes to a couple, the numbers change even more. So now we see that there's a 98% chance, a 25% chance that one of those two members of that couple are going to live to age 98, which is very long life expectancy. It's much longer than we've seen in the past.
Yeah, it changes the dynamics of retirement planning. I mean, if you're going to plan on being around for 30 plus years,
right,
you got to pay for it.
Right.
And then you got to be ready for it. And these are the kinds of, this is actually a risk. So let's take a look at what's next. Healthcare costs are probably one of the bigger issues that everyone talks about. You know, the healthcare costs are going up, and who's going to pay for them? And this is not Medicare. This is 65-year-old couple. This came out, I think this is a Fidelity study or somebody did this.
I think this one's Fidelity.
Yeah, they found that there's an average out-of-pocket healthcare expense during charge outside of Medicare, outside what you're paying insurances for, of roughly $260,000 over the course of that average 30-year period of retirement. And that's also increasing at a higher rate than inflation. So this does not include the cost of long-term care. This is just healthcare expense. So we're going to talk about long-term care as a separate issue.
Right. So when we talk about long-term care and the need, the odds of needing long-term care are about 70%. So a higher and higher percentage of people are needing it because of those longevity risks. And on average, the need lasts for about 2.5 years. But again, that's an average, right? So there's people that need it much longer than that because there's people that obviously pass away much sooner. And as we talked about earlier with longevity, women are more likely to need extensive care and for a longer period of time than men. So these are all issues that we need to look at when it comes to longevity and the potential of needing long-term care.
So what's long-term care? What is it? Well, there are medical and non-medical needs. And generally what this is for people with a chronic illness or disability who can't take care of themselves. And you're going to see in just a minute, specifically what that disability is spelled out by law. And what we're doing here is if you qualify for those, they're called activities of daily living. If you cannot do 2 of 6 activities of daily living, we'll look at the specifics in a moment, then you are considered to be disabled for long-term care insurance. And what happens at that point is you're going to need help. And when you get the right help, it's for an individual, it's coordinated with other services, and it's obviously meant to keep people independent, increase and maximize their quality of life, and help that patient's need over a long period of time. And for those of you who've had experiences in dealing with parents who are in stages like this, it is a situation you can't ignore.
Right, and it's not always so easy to discern when you're kind of crossing into that phase of your life, right?
What is relatively easy though is this is elder law, and this is a big deal. Like AARP is all over this. So if you can't qualify to do one of these are called activities of daily living, then you technically qualify to be on claim for long-term care coverage or insurance to the extent that you have it.
Right.
And it's pretty simple. You can't do these. Someone's going to be able to say pretty quickly that you can't do that. And generally a doctor, a physician, or a physician's assistant would verify this, and the claim would start.
So what are the costs of long-term care? I mean, here we've already talked about a little bit, but let's look at what this is a national average based on a Genworth study. An assisted living private one-bedroom assisted living facility is $4,000 a month, and you can see the costs go up pretty dramatically after that. A home health aide is about the same, $4,195, but that's for 44 hours a week, leaves a lot of alone time. And then you get into the cost for a nursing home for a semi-private room, $74.41, and when you get into a nursing home private room, the numbers get scary, right? $8,365 on average. It's higher around where metropolitan areas.
Interesting to see this too, because people, what I've seen in my experience is you'll see these step-up scenarios. When you get to a certain situation where you need assisted living and somebody to help you, and you're going to go into an assisted living facility, or more and more people are wanting to stay at home and get help at home, and that's that home health aid. So you can see that's generally where you start. It does tend to accelerate into more and more care, which may mean you're going in from assisted living into a nursing home facility. So you may start at $4,000, you may end up at $8,000, depending on what your level of care is going to be.
Sure. So we thought it was important to take a look at Medicare and long-term care because people don't really understand, not everybody understands what Medicare pays for, what it doesn't. So generally speaking, Medicare does not pay for long-term care. Medicare only pays basically what it says here, only in certain conditions, when certain conditions are met and for a very short period of time, a maximum of 100 days. So when people think that Medicare is going to pay for long-term care, they need to reevaluate and understand that what Medicare pays for and what it does not pay for. And then we thought also we should talk about Medicaid because people hear about Medicaid paying for long-term care. Now, this is a partnership between the state and the federal program, and it varies by state exactly how it works. But as an example, here in New Jersey, a 65-year-old individual can qualify for long-term care services if their income is no more than $1,437 a month. It's $1,945 for a couple. And that includes Social Security income. So it's going to disqualify a lot of people, probably many, many people that are on this call who have employment and retirement plans and Social Security. And also the asset limits are extremely low. So you have to have spent down $2,000 to the amount of $2,000 for an individual and $3,000 in financial assets for a married couple. Certain things are excluded, but we're talking about financial assets. And if you have more than that, those financial assets are subject to a 5-year look back. So you can't give away $200,000 and think you're going to get Medicaid to cover you. They're going to look back and see what the average is in your area per month and deduct that from what you've given away, and you won't qualify for Medicaid coverage until that money would have been gone otherwise.
Yeah, basically you have to be kind of broke.
Right, exactly.
It's
Financial
really
assets have to be pretty much gone, and you have to have planned well ahead if you wanted to be able to qualify.
I mean, there are potentially some ways you could maybe play the system a little bit by having different Medicaid trusts, but be careful with that because there's a lot of media out there and a lot of providers out there that promote that, which may or may not necessarily work. So
Right.
Be careful with that.
Right. You don't want to get caught because there are penalties as well.
Yeah. Anyway, traditional long-term care options. What do you do? What if you don't? What if you just say, you know what, this is fine. We'll take care of our own, and that's fine because you're not going to pay any insurance premiums. You're just going to do it on your own. You're not going to pay for any nursing or home health care. But that means someone has got to do it. That means literally you got to do that.
There are a lot of family members that are doing it.
Yeah, and that's the issue we've seen there is it changes the caregiver if it's a daughter or a son or a grandchild or nephew, niece, whatever. I mean, their life just changed.
Takes a major toll.
Absolutely. So it creates issues in the family, and you can see that it's not like something that we'll all look at and say, I don't want to do that because we all care about our families, but on the other hand, there is a quality of life impact, not just for the person involved, but usually for the entire family.
Sure. And if it's one family member, it can often create family discord. That one person who's the primary caregiver doesn't really get days off, right? It's not a typical job. So it definitely is something that needs to be considered long and hard before that's what you commit to. Then there's self-funded, right? So pros of being self-funded is that you only spend what's needed. You spend as you go. So there's no the other part of that is it doesn't require any advanced planning. If you assume you have enough assets, or whether even if you don't, you basically spend what's needed when it's needed. Obviously, the cons of that are running out of money. And another con is leaving too little. Let's say you use it for the first spouse is gone, and now you've used up a whole bunch of your money, or if not all of your money, and you leave too little for the surviving spouse. And then they're kind of on their own, they're older, then what, right? And then the third source here is insurance. And some of the pros there, the payments are guaranteed, and it does provide peace of mind. Jim, you can talk about that firsthand with your own dad, right? And on the con side, it requires advanced planning. You can't just buy it when you're going to need it. You have to buy it in advance. It can be expensive. The costs have been known notoriously to increase over time. And the other knock has been that either if you don't use it, you lose it. So you've been paying for it for a while. So let's focus in on some of those cons with traditional long-term care insurance?
Well, I think for those of you who have it, and you can get it in many different ways. You can get it as part of a group plan. There are group long-term care benefits out there, and I suggest that you look at your benefits to see whether or not it is an option for you to choose. It isn't a bad way to go. The odds of long-term care happening before age 65 are not significantly high. So usually long-term care is post-retirement,
Right.
when you're older and need help for long-term care, things like we've covered. But it is something to look at. Sometimes those group policies are transportable or portable. You can take them with you. But the issue we run into with that's what we call traditional long-term care. You pay a premium, whether you get it through a group or buy it individually. Generally, you're at risk of increasing premiums. The insurance companies have the right to increase the premium on the entire group of policyholders in a certain policy class, and that's what they've been doing. And that's what we're seeing in the marketplace. We're going to show you a real life example in a minute. And what we're also seeing is because they perhaps underestimated the longevity and the other risks we talked about earlier, you may see a decrease in your benefits. So that could be a problem for you if you're paying all this money and all of a sudden you're not getting what you thought. The other thing about traditional long-term care, it's like your fire insurance. If you don't have a fire, there's no
The
compensation.
premium's gone, right?
You paid that money, so it's definitely that use it or lose it, and you don't get anything back for the premiums you paid.
So speaking of increasing premiums, Jim, why don't you talk about this?
This is a real life client. It's not a great picture here, but it's literally taken off the bill that they recently sent one of my clients. So this young lady is probably close to 70. Her premium was $51.65. I think that's what that says.
Yeah.
Last year. And this is unfortunately, a fairly common notice that we're seeing over the last 5 to 7 years come from the long-term care providers, which are basically saying, look, we're going to have an increase in the premium. And you have some choices. You can either stay with where you are, and in this case, the premium went up. You can sort of see it here. It's $10,000.
It's almost double.
It's almost double.
It is pretty much
so
double.
This is a 1-year increase of double, okay? Then they said, well, that's too bad, but you can pay less and just get less benefits. So basically, you're cutting your benefits down to try to save in the cost. But even if you did that, I mean, you're cutting benefits, you're still having to pay a significantly higher premium than before. And this is what we're seeing. Now, does this happen to every policy all the time? No. But be prepared to understand that there is a guaranteed policy and a non-guaranteed policy, and make sure you ask.
Yeah, that's a tough to swallow.
Tough
when you've been paying those bills for years, and then you get a bill like this, and you think, well, now I'm between a rock and a hard place.
Yep. Let's talk a little bit about what we like or what we've seen in the marketplace that solves some of these problems. They're called hybrid policies. They're actually interesting, and they're hybrid because they're kind of a cross between long-term care insurance and life insurance. They have a little bit of each component in there. You can actually pay a fixed amount. You can pay it in one payment if you wanted to and just be done with it. You can fund it all up front. You can fund it over any period of time, 3, 5, 10, 7, 20 years, whatever it is. You can pay it over lifetime. And these are guaranteed, so you're not going to see premium increases. Generally, you're going to get the same monthly amount that a traditional would provide. You pick what monthly amount you want. The benefits are guaranteed as long as you pay the premium. If you died, and before you even got $1 for long-term care, you're going to get a death benefit to basically almost pay back what you put into the deal. And if you say, wow, that was a great idea for 10 years, but I don't want to pay this anymore, a lot of these products that you put money into, you actually get what's called a return of premium, meaning you get some of your money back, even as high as 80% of what you put in. So these types of policies are generally the direction that you want to look at if you're looking at funding your own long-term care.
Right. So these are the answers to some of those big issues. The death benefit, to me, is one of the biggest ones.
Yeah, we're going to take a look at an example here in a minute. So here we go. So this is a sample case, male age 64. So we're just using this as a hypothetical. And you're going to learn that you can actually design the product to cover your specific situation. In other words, it doesn't have to be this. These numbers are all based on age. So if you're younger or older, it might be different. If you're in a different state, it might be slightly different due to different state pricing. But this is an example of how this hybrid product looks. Basically, this individual would pay $12,828 for 10 years. Great, put that in there. Something called surrender value is the money that you would be able to take back if you say, yeah, I'm good with this, I'm done with it, I don't want any more of it. You can get a lot of your premium back into that return of premium feature. So, for example, in the 11th year out here, you got $89,000. If you say, I'm done, get me out, you get that back.
Right. So it didn't go into the ether.
Yeah,
that money's not gone.
It didn't disappear like some of the other premiums you pay. Now you're paying more up front typically for a solution like this. But remember that death benefit feature we talked about? So if I died anywhere along the way and I didn't use any long-term care, in this specific example, I've got $156,000 of life insurance death benefit my beneficiaries are going to receive. Well, think about that for a second. I put 128 into this thing, 10 years of 12 grand. I'm going to get 156 back. So that's not too bad. I can kind of see the wisdom of saying I'm going to get something out of this, even in a worst case scenario. But what are you really buying? This particular solution was buying $6,000 a month for an annual benefit of $72,000.
Right.
That's what this number is right here, that $72,000. You can sort of see that the column that says annual. That's my benefit that I'm going to get every single year. I'm going to get the opportunity to draw upon that and use $6,000 a month for $72,000 a year. And I'm doing that for a total of 6 years. If you do the math, 6 times 72 is 432,000. That's what that number is.
Got it.
So if I am looking, and this individual thought that he was maybe a little bit looking to be more conservative, he wanted to cover off $6,000 a month, and he wanted to have it for that period of time, for what, 6-year period of time. So he's probably overshooting the average, but that's okay. And everyone should be the average. So he's going to be able to get $72,000 a year, and
a year for 6 years.
For 6 years,
depending, no matter what year you start.
That's correct.
Right. Got it.
And if you don't use $6,000 in 1 month, it rolls forward to a future time where you can draw upon it. It's not a use it or lose it on the benefit.
Sure.
So that's a real quick scenario. What these IRR things on here, just because I'll complete the rest of the program. IRR is called internal rate of return. And for all the financial geeks like me out there, that's how we figure out if this is a good rate of return on our money. In other words, if I were to have given an investment advisor this same $12,828, what kind of rate of return would I have to get to make it the same? And let's just use a year, for example. Let's go out to age 88 out here. That's 5.4% rate of return. That's after tax, tax-free, 5.4% guaranteed rate of return that I would have had to have earned on that same money.
On that $12,828 that you put in for 10 years. Right.
To get the benefit I'm getting out of this product. So it's a really good, actually it's a superb guaranteed tax-free rate of return. To the extent that you're using it, we think this is why it makes financial sense. Again, this is one example with one set of scenarios. What you need to think of now is, okay, I kind of get the concept, Jim.
Well, let's talk about now.
How do I make it my own? What's the right number for me?
There are a lot of moving parts here, so why don't we talk about what a long-term care design looks like?
Yeah, and the key word here is design, folks. You can actually put together a product solution built around what you need, what you can pay for, what you think you are going to provide in a benefit. So if you say, hey, I need $150 a day, or I need $3,000 a month, or whatever that number comes out to be, you can actually tell us what that number is, and then we will run the projection for you. It's a computer game. You basically run projections for people.
Some people might want to shop by budget, right? They might say, I only have X number of dollars to pay for a premium, and I want to cover 3 years, or 4 years, or whatever that number is, right?
So basically, the key number is how much you want a day, which converts, times 30 is how much you get a month.
Sure.
How long do you want it for,
mm-hmm.
right? So those are two key things you have to ask. Okay, I want X amount a day and X amount for this period. Inflation riders, we'd recommend them because the cost of this stuff is going up with inflation. And then you have an opportunity to pay this in different ways. You can pay for it all up front. You can pay for it over your life. You have all kinds of ways to pay for it. It's kind of like a mortgage. You sort of have to just run the numbers. And the rest of this will come with the once you get an understanding for what it looks like, how these other features like getting the guarantee is very important. Making sure that you're getting the reimbursement program as a minimum is very important. And certainly you want to look at the capability of the insurance companies to pay it.
So to sum it up, let's look at long-term care risks to retirement income and the fact that they can be dealt with in advance. And remember, please go to GoPlan101.com and look for more resources there. We have plenty of them.
Yeah, GoPlan101.com. If you go to the site, or if you've been on the site, you also notice that we've got a YouTube channel. We put a lot of content up there, particularly in the form of short videos. So thank you for attending this 20-minute one. But if you just want additional information, we've done a series of content articles and videos around long-term care, life insurance, and a number of other subjects that we think fall under the term financial wellness. So please go ahead and use that resource. If you've got any questions, you can find our contact information on the GoPlan site. Please feel free to reach out to us, give us a call, send us an email. And we look forward to doing more of these in the future. So thanks for your attending.
Have a great day.